Hello, ladies and gentlemen. How are you today? I hope all good. I would like to thank you for this opportunity to be in the 38th IBIMA conference in Spain. My name is ADHYASA, and I want to present about my study. The topic is the importance of human capital efficiency on the equity funds performance during the COVID-19 pandemic in Indonesia. Well, this is research explored the importance of human capital efficiency on the performance of equity funds during the COVID-19 outbreak in Indonesia. The measurements of the performance that provided an overview of resilience to downturn periods were critical, such as during the COVID-19 pandemic. This research tried to verify the connection of human capital efficiency on the performance of equity funds in a heavily impacted country, Indonesia, in 2020. Okay, there are choices of financial assets such as stock, bonds, and funds. Funds, the mutual funds. Currently, they are more accessible now. They are more accessible due to the rise of fintech, the financial technology. There are some them who are more accessible in Indonesia. But some people don't have enough time and lack of understanding ability to choose which assets they want to buy or invest. Some people with this type of personality of risk aversion usually invest in mutual funds. Why? Investors could invest in mutual funds according to their ability by entrusting their management to the investment manager. Investment management plays an essential role in mutual fund performance. A more skilled manager should be superior to others. These assumptions are based on the latest studies, as you can see here. At the end of the 2019, the world was shocked by the emergence of the COVID-19 virus, which resulted in a prolonged outbreak. There are a lot of research about COVID-19 and the financial market. As you can see, the latest research showed that there was a substantial increase in volatility in global markets due to the COVID-19 outbreak. This is by Zhang, 2020. The mixed performance of mutual funds during the COVID-19 pandemic in the EU had been reported. This is by RISV 2020. How about in Indonesia? Of course, Habir and Wardana 2020 highlights that the pandemic of COVID-19 also impact Indonesia. The pandemic worsens public health and economic growth and produced higher uncertainty in Jakarta. The question is, are the mutual funds or the equity funds still worth? In some investment strategy, mutual funds usually acted as painkillers. Those expected to produce a consistent positive alpha. Market timing and a vital fund manager's skill to maintain performance in active investment strategy. Correlation between human resource and mutual funds. However, there was little evidence on the relationship between human resource efficiency and mutual fund performance in Indonesia. Therefore, the study further discussed the topic, especially in the difficult situation during the COVID-19 pandemic, which greatly affected the Indonesian market. Next is literature review. In this study, we have the first hypothesis. NAOS in 2019 report, NAOS report showed a positive connection of intellectual capital and the market value of banks. MELS 2016 highlighted the connection between the efficiency of some banks and their investment in intellectual capital in general. And Mirza on the research in Latin America found that equity funds with high level of human capital efficiency was able to outperform other equity funds with 6 performance measurements. So we have the first hypothesis that there is a positive impacts of human capital efficiency on the performance of equity funds. Continue to the next hypothesis, the second one, that based on this review, we have the second hypothesis that there are differences in abnormal return of equity funds in the period before and during the COVID-19 pandemic. This is based on the study in the EU market by Yarovaya, and found that during the pre-COVID period, mutual funds in the largest human capital efficiency category showed positive cumulative abnormal return. Next, the research method. The population in this study was equity funds, which data were available at an investing portal in Indonesia. The sampling method used certain criteria. The criteria were the first mutual funds that operate during the period of 2019 to 2020, and the second issued a report on the development of net asset value for 2019 to 2020. The total number of equity funds collected was 300 mutual funds in Indonesia. This is equity fund, of course. However, due to the limited data from each equity fund, especially the disclosure of investment management service fees in the prospectus and financial statements, as well as the reduction due to data outliers, the equity funds were selected to be 102 equity funds from January 2019 to December 2020 to be tested. Okay, there are two approaches used in this research: associative and cooperative methods. The first hypothesis uses an associative method, and the second one used a cooperative method. The focal point of this research was to prove that the effect of human capital efficiency on the equity fund's performance in the pandemic period. Human capital efficiency was a quotient of value added and human capital. This is by Yarovaya 2020. It could be expressed as this formula, as you can see there. Yeah, there. Human capital efficiency can be calculated by this formula. Human capital is investment in HC is an investment in human capital. And the VA for fund is estimated, VA I mean value added is estimated as product of the capital asset pricing model based funds alpha and asset under management. You can see there as AUM as previously used in the previous research by Europaya 2. And all data used to calculate the human capital efficiency was the 2019 data related to the asset under management, net asset value, and investment management fee for each mutual fund are taken from the investor portal in Indonesia, namely Bareksa. We used the daily net asset value from January 2019 to December 2019. The further step was to analyze the impact of human capital efficiency on every risk-adjusted measurement used in this result as dependent variables. To test the first hypothesis, it was necessary to consider the performance measure of equity mutual funds as the dependent variable by multiple measures. This included the Sharpe ratio, Trainor information ratio, and Jensen alpha, also Sortino ratio and Modigliani measure. You can see the formula here above. Data related to the daily NAV of all funds were taken from the investment portal, Bareksa, again, then the Indonesia Composite Stock Price Index data as a benchmark, and 10-year government bonds as a free rate were taken from investing.com and World Government Bonds website. The assessment started on the 2nd of March 2020, when it was reported that there was the first COVID-19 patient in COVID-19 victim in Indonesia. The full period spanned from March 2020 to December 2020. This is the formula of Jensen alpha and the Modigliani measure, or we can call it MM measure, MM. Okay, control variables. As a control tool for the linear regression equation between the human capital efficiency and the equity fund performance measure, we use control variables such as fund size and fund age in this research. In this research, also related to the influence of the character of managers who adopt restricting and then produce a better performance from funds, fund size and fund age variable are also used as controls by Andrew. Before entering into the logarithm, the net asset value, I want to talk about the formula of the fund size. Before entering into the logarithm, the net asset value is average from the previous year, t minus 1, okay, plus the net asset value in the pandemic, there. Okay. And for the fund age, we can subtract the research date from the effective date of the equity fund, each equity fund. This is the regression equation. could be concluded an OLS regression formula used to test the first hypothesis. KDRDS is a free risk-adjusted measurement. HCE is human capital efficiency. FS is fund size. FA is fund age. Alpha is estimated constant. Beta 1 till beta 3 are the coefficients of each independent variables, and the last one is errors. Before testing the first hypothesis, the research needed to test the classical assumption to see if the data used are suitable for use in the regression equation that has been formulated. Given the relevance of human capital efficiency, the second hypothesis addressed that there needed performance difference between before and during the pandemic period. This from the study of 2020 by Mirza. This comparative method used the type of event study, which aimed to see the difference of performance in a pandemic event, starting from 199 days before the first case of the pandemic was announced as the period before the pandemic, and 199 days after the first case of the pandemic was known as the period during the pandemic. So we use the 2nd of March as I stated before. Researchers used cumulative optimal return as a measuring tool in testing differences in performance before and during the pandemic. Then tested the average optimal return before and during the pandemic using the Wilcoxon sign test by Wilcoxon 1945. The following was the equation used to measure optimal return. ARIT is the optimal return of the equity fund. RIT is the actual return, and ERIT is the expected return of the equity fund, which could be obtained by the common capital asset pricing model equation. Before conducting the sign rank test, the researcher then divided the equity funds into three categories based on the high, low levels of human capital efficiency. So we divided into three categories of the equity funds: the high category, medium category, and low category, based on the high and low levels of human capital efficiency. The aim was to provide a more precise interpretation of the relationship between the human capital efficiency and the difference in optimal returns before and during the pandemic. Whether mutual funds with the high category could outperform other mutual funds or vice versa. As for testing each statistical test in the study, we use IBM statistic 26 software, and the significance level used in this research was 5% or 0.05. Next is we can see the findings in the first hypothesis. Table 1 showed the result of descriptive statistics related to the first hypothesis. If you look at the independent variables, the highest human capital efficiency was value of 0.0614. This shows that the efficiency level of human capital itself is quite small for this population. The control variable, however, the fund size, had an average of 25.754086, and for fund age, the average age of mutual funds was under 10 years. Next, we move to the dependent variables, Sharpe ratio, trainer, Sortino, and the others. The Sharpe ratio had a minimum value of minus 0.0104 and the maximum value of 0.0583 with an average of 0.023310. On average, the Sharpe ratio measure was ranked second for the best performance. The first rank was the Sortino ratio measure with a maximum value of 0.0814 and minimum value of minus 0.0143. The results shows that each mutual fund performance measure produce different outputs. Thus, we need to see the effect of human capital efficiency on mutual fund performance from each previously tested measure. Every regression formula over had passed from the all classical assumption test for the first hypothesis. We could conclude that the residuals of every regression model was normally distributed. There were no multi-collinearity and autocorrelation problem, and the models was not heterogeneous. Therefore, the study continued to test the hypothesis. There were two hypothesis testing used to test the first hypothesis, the F-test and the T-test. According to the whole period during 2020, starting from March 2020, from the F-test, human capital efficiency on all equity funds show a significant effect. 0.05 of all equity funds performance measures. The results mean that the independent variables and all of the control variables had a simultaneous effect on each measure of the fund performance. Even so, it was necessary to partially re-examine the effect of human capital efficiency itself by looking at the t-test result. Yeah, okay, this is the t-test. This is the f-test result, and this is the t-test result. I'm sorry, the f should be t-test. Okay, this is should be t-test. I'm sorry. Okay. We found that the only human capital efficiency had a significant effect on all mutual fund performance. As for the coefficient of each independent variable, they were different, but all of these coefficients were positive, which means that each additional unit of each independent variable could increase the result of the mutual fund performance measure. Therefore, the results of testing the hypothesis were proven. In other words, the null hypothesis was rejected. Yeah, in order to provide a clearer interpretation of the result of the hypothesis testing that we have seen before, the researcher divided the human capital efficiency into three levels, as I stated before. There are low, medium, and high category. Then the researcher made some figures of the average mutual fund performance measure for each level of human capital efficiency. This is the figure. Yeah, as you can see, the figures clearly showed that during the pandemic, equity funds that had high human capital efficiency had outperformed other mutual funds, equity funds with lower human capital efficiency, especially if you look at the result of the trainer ratio and the information ratio, and of course the Jensen alpha, this Jensen alpha. Mutual funds with low human capital efficiency show a negative performance. The finding indicates the importance of human capital efficiency on the equity fund's performance. The second hypothesis, we divided the cumulative abnormal return data into three parts based on human capital efficiency categories. The equity funds classified as having a low human capital efficiency will be called low. And that's all. Its share was 30% of the total equity funds studied. Here was the result of the classification. These are the names. The cumulative abnormal return for equity funds in all categories before the pandemic will be called CAR all before. The cumulative abnormal return for equity funds with high categories before the pandemic will be called CAR high before, and so on. So we get eight types of the cumulative abnormal return. The result of the tests above were still in a form of ratings. The high category and the minimum category had the same result. Three negative ranks. This finding meant that only 3 days during the pandemic were experiencing a decrease in abnormal return during the pandemic compared to before the pandemic. Yeah. So we can see the negative rank here, 3, and the 3, 3, 3. Okay. Meanwhile, there were 21 days during the pandemic in low category that were experiencing the negative rank. Right there. Right there. 21. The same table shows that 196 days during the pandemic were experiencing positive rank. For the high category and medium category, respectively. However, for the low category, only 178 experiencing positive rate. If you read the table, we get the positive rate. It means before the pandemic, we have the positive I mean, it get raising. It get raised from before to the during pandemic. And the negative, it's a downturn. This finding means that along with the low category, only 178 days experiencing an increasing average cumulative abnormal return during the pandemic compared to before the pandemic. By seeing this table, we can have the insight. The results prove that mutual funds with a high level of human capital efficiency generate more positive ranks or higher abnormal returns during the pandemic compared to the mutual funds with a low human capital efficiency. This is another show for average cumulative abnormal return ranks. This is the result of Wilcoxon test. The table of this test showed that the significant level of all variables studied had a value of 0.0. This means this finding indicated the variances in cumulative abnormal returns in the period before and during the COVID-19 pandemic in Indonesia. Therefore, we concluded that the second hypothesis was accepted. To complement the result in this research based on classification, we made a graph of cumulative abnormal return starting from 199 days before the pandemic to 199 days during the pandemic or after the pandemic. The graph was shown below. Yeah, from the figure, it was apparent that before the pandemic period, from day 1 to day 119, the equity funds that had high human capital efficiency category outperformed the mutual funds with a lower human capital efficiency. The overall results supported this research finding regarding the impact of human capital efficiency on the performance of equity funds. The equity funds that consistently performed well were those that had a high human capital efficiency. So what is the conclusion of this research? Yeah, the performance of equity funds were dependent on the investment strategies employed by the portfolio managers in Indonesia. These managers represented the human capital, and investment in this research contributed towards human capital efficiency. Every measure of mutual fund performance in this study, we chose the equity funds performance, was proven to be more significant if it had a high human capital efficiency level, especially during the pandemic COVID-19. The difference in abnormal returns showed that during the pandemic period, it would be crucial for mutual funds companies to increase efficiency of human capital. Similarly, it is important for investors to consider investing in equity mutual funds with the best human capital efficiency. However, the study had a limitation in the availability of data related to the investment management fees as a representative of investment in the human capital, which not all mutual funds publish the data in the investment portal. They're all my presentation. Thank you for your attention and see you later.